IVM.
Folks, welcome and thank you so much for joining us on this episode of the Ideas Project, a limited series by Small Case. I'm your host Anupam Gupta, and today we are joined by two guests, Swarup Mohanty and Deepak Shenoy. Swarup is the CEO at Mirae Assets and Deepak is the founder and CEO of Capitalmind, both of which, Mirae and Capitalmind, are companies involved in providing comprehensive financial services. Mirae Asset provides services like asset management, wealth management, investment banking, and life insurance. Capitalmind provides equity, fixed income, macro, and personal finance research for DIY investors. Also has a portfolio management service, PMS, offering a range of equity and fixed income strategies for long-term wealth creation. In other words, folks, both our guests are experts in the field of finance and investment, making them the perfect guests to talk about today's topic, disruption in savings that we're seeing in the Indian markets today. What are some major trends in the savings industry currently? What aspects of it should you have your eye on to make an informed investing decision? Stay tuned till after the break to find out. Are you looking for finance products and services that can enhance your personal finance experience? Are you looking for a space to talk about your financial product or service? And are you looking for a crisp talk show where the conversation is all about money? Well, your search ends here. Hi, my name is Anupam Gupta and I'm host of the Paisa podcast, and I invite you for the conversation about your personal finance on each Monday on the IVM podcast app or the website or on any podcast streaming platforms. See you folks. And welcome back. Swarup, Deepak, welcome to the show. Great to have you here.
Thank you so much for having us. Really an absolute pleasure. My first time with you, so looking forward.
Thanks, Swarup. Okay, I'm going to keep the questions, feel free to jump in and give your views on each other's questions, but I'm going to start with Deepak on the savings industry as a whole. Then I'm going to go to mutual funds to Swarup, and then the outlook, we'll try and switch questions between the two of the guests. So let's start. Deepak, this is for you. What do you think is the size of the Indian savings industry, if you can call it that, and if there is any way to estimate that?
So, I think the savings industry has, if you consider Indians save in two kinds of ways. If you look at it from the old traditional way has been gold and real estate. The estimates of that in terms of current values will be a little bit more than GDP, because GDP is just the new value that's created in a country at any given point in time. So there will be a certain amount of assets there. Roughly 50% of all saving in India household savings has actually gone to gold and real estate, or the total stock is there. The rest is in financial savings, which is whether it is fixed deposits, insurance, mutual funds, and all of the other kind of financial assets that you may call that is another set. Rough ideas here, I think mutual funds are around 35 odd lakh crores. Insurance is probably about 35 to 40 lakh crores, a little more than that. And we have the largest bulk, I think, still sits in fixed deposits or in bank deposits, rather. That's an order of multiple more, I think it's 100 and something thousand crores. So largely, these are the total total savings of the country. If you look at just financial assets that are added to the economy, I think we've done about 20 lakh crores. The run rate is about 20 to 25 lakh crores per year is getting added to financial assets. As of Q2, that is September 2021, that's the last I have data for, from a pure financial services angle. And the scale of this is largely divided into, bank deposits, which is a bulk. It's roughly 40% of all the financial savings. And then the rest comes in from non-bank deposits, insurers, provident funds, mutual funds, and so on.
Great. Thanks for that detailed breakdown, Deepak. Talk to us about the disruption in saving. You spoke about physical, you spoke about financial. We know that, and of course, you gave us the traditional avenues of saving. What is a disruption in savings that's been happening in these last 4-5 years? Talk to us about that.
So what's happening slowly, and this is a phenomenon that's been happening from 1951 also. If 1951, India was like 1% financial, 99% real, and now it's gone up over time. But it's accelerated over the last decade and a half. I think that's the reason for this is increased digitization of money. So more and more, less cash is being used in comparison with the earlier times as compared to the proportion of money that's being used through digital means. That allows digital access to a lot of instruments that were traditionally more difficult to get, whether it is bonds or insurance or mutual funds or just fixed deposits as well. That part of the ecosystem has started to increase quite substantially. At the same time, there has been a lull or a slowdown in prices. Gold, for instance, in dollar terms, is lower than what it was 10 years ago. The only reason it has increased in rupee terms is because India has added some 15% tax and there's a rupee depreciation compared to the dollar of 4% a year. So gold itself, the returns have come down. Real estate returns broadly, some pockets will do really well, but broadly real estate returns have been very benign over the last decade compared to previous decades. So given this, I think the interest has also started to move towards financial assets, and pretty strongly so. So we're seeing inflows in mutual funds, we're seeing inflows in insurance, we're seeing net inflows. I mean, even an employee provident fund organization is reshaping its book to largely what used to be government bonds and debt to more of equity. So there are significant players now in the equity ecosystem from almost being nobody 10 years ago. So the financialization and then the broadening of the financial base beyond just government bonds or AAA rated bonds has increased the level of participation of almost everybody across the ecosystem.
Yeah, Deepak, before I go to Swarup, one last question. You spoke about broader trends over the last decade and a half, 10, 15 years, and you're saying that real estate and gold haven't really given great returns. Anything in the last 4-5 years, just pre-pandemic, are you a believer of the whole, the push that came in from digitalization and the jam trinity and stuff like that has helped the financialization of savings?
Oh, substantially, also because we had a free money regime in the US and the West, right? So they pumped in more and more money into, say, startups in India. Startup investments are one of the largest sources of FDI in the country, and that is almost the largest source of financial capital that is inflow into the country. Even greater than, in some quarters, even greater than NRI money like remittances and so on. So this money that's come in has all been white in bank accounts. They've been given to people. This is part of the digitization process because they've used a digital means to get more and more people onto the platform. But at the same time, you have UPI, which is equivalent to cash, instant settlement. I don't have to wait for your money to come in. I don't have to wait for your check to clear. I don't need a credit card machine. I can just use my phone. This part has massively changed payments. This has also changed the mutual fund and insurance and all of these industries, because now they can get access to people, can directly give them money without so from 2016 onwards, when we had the demonetization thing and then people started to move more digitally in, this has actually improved. So even during demonetization, although it was at that time, I remember using UPI, I've used digital means for a long time, but I've used digital means to pay even small vendors. Today, you could get your shoes fixed at a mochi and pay 10 rupees on a UPI platform, and it would be instant settlement for the person. You don't need to use cash. So I think that has probably hastened the increase of saving in financial terms. Also because when you have cash, you have to go to the bank to deposit and then use the bank to invest, because almost all investment avenues require you to have a bank account. Now, if the money directly comes into your bank account, you don't have that extra effort of going to the bank, depositing, etc., etc. So again, removing a friction, I think, has helped, increase the process. And digitization is a significant reason why friction has been removed.
Great. So, your thoughts on whatever Deepak said, on this shift, this disruption in savings, how we've changed as a country. Before I move to the mutual fund related question, any thoughts on what Deepak said?
I think broadly agree with Deepak on what he said, and some of the significant events that have happened continuously has changed the mindset of people. I think broadly, India remains a very fixed asset, fixed saving kind of investment background. But the dismantling of interest rates or fixed interest rates has played a big factor in movement, and subsequent transparency in real estate values and gold values have made awareness of the growth of that asset. Otherwise, it had become a very subconscious kind of a thing. And I can spend 1 hour on gold investing and the behavioral aspect of gold investing. But that is changing. And you have to also keep in mind the change in demography of the country. And also add to the fact that this demography not only thinks very differently, they are economically very different from, like, if you compare me to my father versus my son, there's a stark difference. So the way we view investing and our savings is looking very different from, say, my previous generation. But two things which changed everything, and I think Deepak started with it. I think Demon was a huge change from the mind shift of every individual. It started financialization of assets in a real term, and the digitization just enhanced the whole thing. And I think COVID was the kicker that we needed in that process. And I leave it at that, and then we can progress further on the discussion.
Let's pick it up from there, Swarup. Trend in SIPs pre and post-COVID. Your thoughts?
Yeah, let me first say that, there used to be this term that before Christ and after Christ. That stands banished now. It is before COVID and after COVID. Yeah, that's the significant impact that COVID will have or has had on our careers. And I think it is perpetual. Because here's the thing, when you look at shutting yourself down for 2 years and in a kind of an environment where you feel fear for your life, you start thinking. And you get 2 long years to think on your life and reflect on the spending. First, your need for money becomes very big in that entire scenario. All of us have gone through this. And in that 2 years, there was this big scope for all of us to finally, come to the conclusion the difference between what is a need and a want. Yeah. And for 2 years, we were not able to spend anything in the want segment, and still life was okay. Broadly in a consumption-based life, you kind of camouflage a lot of your wants in the form of needs and start spending in a different way. But that stance changed, and all of us got this very good opportunity to rework our income expense statement. And hence, I feel post-COVID, all of us stand far mature people when it comes to the way we will spend our money going forward. And that is reflecting. I think from an industry SIP perspective, it started getting a kicker from the mutual fund Sahiye campaign, and you can't deny the coincidence of that on the impact on the mutual fund industry. I thought it was well done, and we progressed well after that. It was enhanced with Demon. The shift to financial investing happened, but the need for investing and hence the need for SIPs got cemented with COVID. And post-COVID, we are seeing a very structural change in the way people are investing. And I dare say SIP has become the go-to investment behavior of individuals. Whether I agree to that or not is a separate thing, but people seem to be taking to SIPs in a very decent way. It leads to participation in the market, which is phenomenal. And it's high time Indians started owning our own markets. Till now, it was owned by foreigners, which was a big, sort of sadness in my mind. That's why I called myself a sad equity seller. I've been communicating equity for 25 years and nobody was listening. So I think people have started listening, getting to the merits of the product. And hence, we will see a structural change in the way SIP will behave. My personal opinion is SIP is a cash flow solution. Here's a person, including me, I'm a salaried individual. I have certain money coming in. So there is a certain money I can participate. The problem happens when you convert lump sums to SIP. And I'm seeing that happening. That's the negative side of SIP investing, is something which I'd like to highlight.
Very interesting. So we're talking about SIPs. They're now, I think, about 12,000 crores per month. And they were about zero probably a decade or 2 decades ago.
Yeah.
If this grows 10 times, if this kind of retail participation grows, 10 times in the next, 5 years or 10 years, do you have any thoughts what will happen then? Any sector that could benefit or anything?
See, 2-3 things which come to my mind, and if Deepak differs, I'd like him because he's from that side. I'm from the business development side, not the fund management side. But let's look at that kind of inflows. And if that happens, I think we have to think structurally on the capacity of the market. That's phenomenal. That's point number 1, which comes in, because fact is Indian markets are not very liquid, and whether we can absorb that kind of money at the underground, there's a lot of work that has to happen at the framework of the market to absorb that kind of money. When that kind of money flows in, the market starts getting stabler. And when market starts getting stabler, the fund managers will have to work far harder to get into that alpha kind of a situation. In a stable market, in a transparent market, the biggest casualty is alpha. And that is bound to happen when this kind of money comes in. And we still don't have some of the largest institutional or government institutional investors investing structurally across the market cap of the industry. Now, so far, the market does say that, yes, some amount of money can be captured on the larger side of the market, of the large caps. But when that kind of money starts moving into the mid and the small caps, I will wait very intently and watch it very closely as to how those kind of balance sheets or those kind of market caps or those kind of free floats can or will absorb this kind of money. That's something which all of us have to think and be very clear before we start accepting that kind of money. I agree that the money is coming. There is no doubt or debate. The biggest thing that is on our minds as an asset manager is that do we have the infrastructure at the back end to absorb that kind of money? And that just does not mean fund management. It means our customer service. It means our digital background, the way the money comes in seamlessly, our pressure on our outsourced Carby, whether we are able to service those clients overnight or in the seamless manner that we have been able to do. Yes, digitization will play a big part, but let's just restrict it to fund management. And I see those parts really needing to up their game when we have to absorb that kind of money.
Yeah. So Deepak, your view, because Swarup gave me a nice link to take your view on this whole, what if, kya lagta hai, as they say in the markets, if the flows really boom.
Yeah, I think I completely agree with Swarup about the fact that Indian markets are not deep. I'll give you numbers, okay? So we trade 60,000 crores a day, maybe 50 to 60,000 crores a day on average. This was 40,000 crores in 2007. So we haven't really improved quite dramatically from then. The GDP has gone up 4 times. So our trading volumes in the market, in the equity markets, is still, very, very tiny. And a significant portion of that is still intraday trading. So it's not really delivery volume. So the actual volumes delivered on a per day basis are far lower. This is equivalent to one stock in the US, one stock. Trading in a single day is equal to the entire Indian market. So unless we see the volumes go up substantially, it will not happen. Secondly, broad basing. The Nifty itself, I think, is about 85% of market cap and perhaps 70-80% of volumes also of the markets overall in terms of delivery. Look at the mutual fund industry also. The largest mutual fund is a Nifty ETF, order of 175,000 crores. The next the largest active mutual fund is probably 40,000 crores, 1/3 or less of the size of the largest passive Nifty only mutual fund. I think passives have to expand more beyond the top 50. We should have at least a top 100, top 250, getting a lot of passive interest. And then you will see a lot of the active interest also move there, trying to generate that alpha by taking opportunities. India also has to evolve substantially on a lot of other fronts also, including corporate governance, insider trading. Hardly anybody has ever gone to jail for insider trading, and we know there's a lot of instances, but there's the teeth of the law isn't strong enough to take serious action. America that way is a lot better. So we should strengthen the institutional power as well alongside. But to give you an example of how crazy this number is, 10,000 or 11,000 crores that's invested by equity in SIPs, 15,000 crores net equity investments in mutual funds today. You can add to that another 10,000 crores roughly coming in from institutional investments, which is typically EPFO coming into equity. The last few months have been that much, about 10,000 crores a month. So it's 25,000 crores a month that is coming here. Contrast that with, let's say, an FII movement. So FIIs actually took out 20,000 crores a month in the last 1 year. So they were a significant force of what took money out of the market. And the local investments just kind of balance that. And they've been able to do this only after about 20-25 years. I do agree that the money will come because people's savings are increasing. People are getting richer. The rich are getting richer. The poor are getting poorer. This is an unfortunate consequence of COVID. So as the rich get richer, they have more disposable income. They have more savings. And those extra savings have largely come into, say, equity markets, primarily because interest rates were at a relative low. So people said, instead of 4% in FD, why don't I just invest in equity? Some of this equation may change. The bond markets may get more interest. Today, for instance, the government bonds at 1 year level are giving higher returns than a fixed fixed deposit from almost any bank in the country. So you're almost saying that the government is the best bank in the country, and that's because we were underdeveloped in terms of even bond market penetration. And mutual funds are perhaps one of the few ways you can participate in them because you can't, it's not easy to get into them directly. But the interesting thing is, now these avenues are becoming available. So I think we will not just see a broadening of interest in the equity markets, but we will see a broadening of interest in the debt markets, in the government bond markets, in structured instruments. I think across the board, financialization will mean more markets and more interest in each market. The equity markets currently can't absorb so much. So if you go to a mid-cap fund, if it has more than 5 or 10,000 crores, suddenly the performance becomes very difficult because now they don't have that many companies to invest in. If you're at 20,000 crores, for instance, how much can you invest in mid-caps? You will actually have to have a significant portion of your capital in larger caps just because, there's not enough liquidity in the mid-cap market.
Sure.
That will make you spread too thin.
Yeah, very interesting. So, what of investments in SIPs, going up and down, although they've pretty much remained stable? What does that say about our economy as a whole?
I think it says a lot about our economy and the growth of India at a ground level. I mean, see, let's face some facts that India reached around 1,000 USD per capita income in 2007. And for the first time, and that was in 60 years, we reached $2,000 USD in 2018. And currently we are at 2,277 in 2022. It says that, the per capita is subsequently increasing very, very steadily. And the so-called middle class of India is becoming real, and that's what is happening. Add to the fact that this demography of this per capita is very different from what India used to be. We are talking about 60% of global population under 30 in this country, and that is playing out. And this young population's economic strata is very different. Their information space is very different. Their outlook to life is very different. Hence, their risk profile is very different. The way they will approach investing may not have any correlation with the way investing was being done earlier. My biggest fear is my son will look up to me one day and say, "Dad, none of your products are good for me." It's possible. And hence, we are seeing this play out. And an SIP is a reflection of the status of the country and a sure fact that there is a serious amount of money which is moving out of the fixed income, fixed asset regime and is going to the financial investing regime. I do believe COVID is the basis or that big padao, as we call it in Hindi, for the start of a financial plan process in India. And I just hope and pray that bulk of these SIP come with a goal in mind. Hence, they can convert this investment journey into a good investment experience and look at financial investing structurally, which would mean something to their lives, not just as an investment. And once you start making your investments more and more tangible, the purpose of investing only grows, and SIP has that power to do that in a very simple but very powerful manner. So it's a reflection on the growth of the country and some amount of reflection on the fact that the the middle class of this country is getting real.
Thanks, Swarup. Let's move to the last part of this episode, talk about the outlook. Deepak, to you, where is the savings industry seeing its main competition coming from? You're already seeing this shift from physical to financial. Is there any other competition that the savings industry could possibly have?
Well, to be honest, crypto has this problem, right? So crypto became one of those assets, and we don't appreciate it much enough. I mean, we are regulated not to talk about crypto, so it's not like something that we can do. But I also see that because of the relatively different regulatory regimes that were made available, people started to shift because they could advertise more. They could use film stars. We can't, as a financial industry, have film stars endorse our products and all that stuff. It's just a very different way. The industry regulator can advertise, but individual participants cannot. So you can obviously see that the demand kind of moves into those kind of instruments where people say, "Oh, big returns, the EVO and all that." But these have always existed. Whether you were teak plantations in the 90s to crazy deposit schemes we've seen crazy deposit schemes forever. MLM, all those kind of things are different ways people think they're saving money, but in a lot of these cases, because of lack of regulation, they tend to become fraudulent schemes abound in these things. So I think that competition will always remain, because that is going to prey on the fear and greed of people. Digitization is going to perpetuate this globally. That means somebody from, I don't know, Europe can scam Indians by sitting here, and Indians can scam. I mean, so it's like you can just do it at a much larger scale than you used to be able to. Therefore, you have to be much more careful. So that's one enemy of this, because it creates that fear, and people then say, I don't want to invest because all these people are frauds. So that is the fear that the industry should have, and therefore I think the industry itself has worked hard towards building regulation or making more and more regulation possible, so that some of these frauds kind of are eliminated from the system, and then people get more confidence. The other part, of course, is different pure play savings avenues. So if you're in today, for instance, I don't think we realize this, more money goes order of, I think, 5 times more money goes to small saving schemes by the government, whether it is PPF, post office deposits, NSCs, and so on. Then that comes into mutual funds from households itself. This is, and then 3 times the amount that goes into 2.5 times. So about 4 lakh crores goes into small savings. 12 lakh crores comes into the deposits every year, bank deposits every year, and about 60-70,000 crores of household income net, because there'll be some withdrawals as well, has come into mutual funds in the last year. So there is a scope for rearrangement of this, but in the process of rearrangement, if you're in one industry, you might see the enemy as someone else from another industry eating your lunch. To an extent, for instance, insurance companies have an advantage. They get to give you tax-free money at the end of X number of years. A mutual fund has to pay, invest in a mutual fund, you have to pay 10% tax. You invest in a PMS, you have to pay higher tax, because, some of it will be short-term gains. You invest in a fixed deposit, you have to pay tax every year, regardless of whether you use the money. So it's these taxation differences that may drive people into one asset class compared to the other. But I think there is not so much of a choice compared to saving. I think our savings will grow. But one of the enemies that, in the last enemy I'll say, is consumption. And I think this is not an enemy, because it will be a friend. Indians save way too much in general as a country. That's my personal belief. I know that economists will not agree with me, but I think we should have a lot more people spending money, because when you spend money, you create economy, you grow the economy. And India is one of the few economies that has the people has enough people to spend and grow. Almost all other countries are aging, including China. They're aging as a population. Our average age, our median age today is 29. In 10 years, our median age will be 33. And I believe, if we focus more on saving than consumption, I don't think us as a country will grow substantially. But if you consume, you don't save, and therefore savings will get affected. Relatively, I think that's fine. If you are a 30% saving country and became an 18% savings country, I still think that's fine, because in general, you will create more avenues that allow you income for a longer period of time than saying, "Yeah, retire karke kuch nahi milega fir uske baad." So consumption, I think, it sounds like an enemy, but it's actually a friend.
So your thoughts? Please go on.
Add to Deepak, because I firmly agree that our biggest enemy is consumption, and as one grows in the economic strata, the first temptation is to fulfill your aspiration rather than your need. India is still a low-end consuming country. Let the brands start playing, then we'll see what real consumption is. I don't drive a big car, but let me tell you, the pressure on my peer to buy a big car is just unbelievable. That's what peer pressure does. And we are beginning to fall prey for that. The good part is we are still not leveraged. So the Baniagiri in our mind is still intact, and that's very good. But I think we have to take into, again, recognize the impact that COVID has had in our lives. And I think that has brought us back a little, and it's in favor of savings. But I'd like to point one small thing in this whole process, as whether it's favor or not. See, we are a fiduciary responsibility. And as savings grow, it is very important for us to recognize and uphold that. While the opportunity might come to the savings industry, it is very important for us to remain very clean. And today the challenge is to remain clean. And if we remain clean, a lot can happen to us. The second part is to be consistent. If we can just put these two things in place and then appeal to that on a longer time of period, consistently for 25, 30 years, I don't think we have an enemy. It is very critical that we also stand up to this occasion or rise to the occasion. And it's very simple. Just remain or uphold the fiduciary responsibility and bring some consistency to that. Once this is through, I think there is enough money in India which can come our way.
Very interesting. Okay. So where do you think the mutual fund industry is headed? Probably talk about it from the key trends: direct versus regular, passive versus active, international versus domestic. Anything? I mean, how do you see the mutual fund industry playing out going forward?
Yeah, Anupam, at this moment, I dislike the word versus because there is enough and more play for everybody. We are hardly getting penetrated. Finally, we are seeing some 8% penetration on the PAN card. So we are beginning to see that unfold. But what is happening, and it's so great to see that happen, is that different type of investors are emerging, different types of partners are emerging, and the play is getting bigger. So there is a space for an active investor. There is a play for an active fund manager. There is a great play for passive investor, and please don't mistake the impact of categorization of funds because it's put into play that this is what it is and period. You cannot ideate more beyond what is there in categorization. That will lead to this unbelievable Indian brain through probably factors pumping in some incredible ideas on the passive sides. Okay, so this is not active versus passive, but pure on ideation. The ideation that one can put on the table on the passive side, because wherever there is an investable surplus, you can create an index, and on that index you can create a fund, and through factors you can create multiple possibilities of that fund, right? So the number of products that can come on that side is mind-blowing, and you will see that unfolding. When you look at the active, the direct versus regular, there are clients on both sides, and mark my words when I say this, in every industry, a client above a certain category talks to the manufacturer directly. I don't think a hotel buys TVs from any distributor. It buys it directly or a fleet owner of a truck does not buy from a distributor. It talks to the manufacturer. Hence, there is an institutional side which had unfolded on the direct side. But when we look at the direct business in India, it is being misplaced, or the role that the RIA is slowly but surely climbing up the ladder on the direct side is not getting discussed enough. So from our end, whenever I put up my direct data, I differentiate between what is direct, pure direct, and what is RIA direct. But the RIA side is definitely climbing, and there is enough money from different level of investors now coming on to direct side. So my humble request is, when you look at the direct side of the industry, please do keep that in mind. It's not pure direct. There is a space for pure direct also growing. And through people writing, through people educating, some people do back themselves in finding which is the good fund, and nothing wrong with that. I mean, the point I'm making is the space is growing very wide. And over the last 5 years, what's happened on the currency, the importance of owning different currencies is also playing out. Today, many people are owning real estate in different countries to safeguard themselves. So why not financial assets across the country? And it pains for me to see the industry at a level where we are not allowed to absorb that money at some valuations which are so attractive at this moment. One does not want it tomorrow, but from yesterday, this looks pretty good. And then we are not at least giving them a chance to leverage or to look at this. I mean, great. I'm sorry, I have to talk about a product. It's just I'm not selling any product. I'm just giving you my experience of what has happened or what I've learned over the last 2 years. We launched a fund which was a 10-stock fund, disruptive tech fund, and I thought it was a very risky fund. I told my team that, go out and just talk risk. And the returns in that category over that last 1 year has been terrible. I would have expected a backlash from my investors saying that, you've got a wrong product. All I got is, when are you going to open that product and when can we, average in that product? Just shows the shift of risk profile of these investors. They understand the products better, and they understand markets far better than what we did 5 years ago. So the point I'm making is, there is a space emerging for everybody, and India is a country where everybody can play. There is enough talent in the industry to give alpha at this moment, though it is shrinking, but there is still enough talent. There is great scope for passive products to come out. International funds are a reality and now form a fair part of the products, or the need for international products is there. All this is leading to good portfolio construction and scope for investors. And fact is, the advisory climate whether it's only through mutual fund distributors or RIAs, along with the influencers or whoever writes the journalists, are talking about the long-termness of this asset class, and that is leading to superior investing experience.
Great. So this last question is for both of you, and it's a message to our listeners who've got a lot of hard-earned savings. What would be your message to our listeners when it comes to investing their hard-earned savings? Swarup, you go first. Deepak, you after that. Swarup, over to you.
All of us are going through this investing journey, and what starts as a return generating process gets into a realization as you mature that it is a risk mitigation process. The more you spend in understanding yourself in the investment journey, the better you become as an investor, because slowly but surely you start understanding your own risk profile, and everybody's risk profile is correct. The objective is to match your risk profile to your investing portfolio, and the closer the match is, the better investment experience you get. And the other point which has been a learning for me is your risk profile is not a constant. As your life grows, your life also changes, the markets also changes, your perception of risk is also changing. Understand your risk. The more you understand the risk, the better investor you become. Then you can marry yourself to the underlying product. You buy a product for yourself, not because of what your neighbor's life is. The second most important point, and that came as a realization very late in my life, is invest with a goal. If you know why you are investing, only then will you know where to invest. Right? Some people tell me they invest for wealth creation. Define that wealth creation. We invest for returns. Define that return. Then you can, judge yourself. As a country, when we put 5 trillion as an economy goal, today we are assessing ourselves, whether we are on track or not. Right? So please put these two in mind before getting into an investing journey. And the third most important part is, it is your money. So please spend time in reading about where you are investing. Please spend time in understanding where your investments go. It's your money, and if you don't take care of your money, be assured your money is not going to take care of you.
Wonderful. Deepak, your message.
Okay, I think, Anupam, I agree completely with what Swarup is saying, and I'll try to add my little bits. And I'm looking at it as a different thing from a journey perspective of an individual. So my theory on the individual side is there are only three reasons or three points about money. First, to take care of your hygiene. So you have to handle your hygiene, which means if something happens to me, like I need health insurance, so I have to have adequate health insurance. If something happens to me that I die and my dependents have to kind of live through the rest of their life without an income, do they have enough? So that is life insurance. And if I lose a job for a few months and I can't find one, do I have enough money to take care of my expenses, which is an emergency buffer? Take the hygiene part of your equation seriously, and that's the most important part. And then figure out where you need money at which points in time, which means your children's education, your own retirement, which is the point at which you say, I don't want to work anymore, so my money needs to make enough returns that pay for my expenses for the rest of my life. There's a way to calculate all of this. But I think those are the financial numbers that you need to be aware of, and therefore build your own investing cycle to take care of these specific goals in mind, which means your retirement, your children's education, perhaps you want to see all the grand slams of tennis in 1 year, and it's going to cost you 25 lakhs. You got to build up that buffer. Well, you know what? Save for it. It's a nice goal to have, and it's a nice thing that you achieve at the end of it. These are things that money is useful for. Once you get past this, perhaps many of us will take a lifetime to just get there, but some of us are fortunate enough to have gotten there already, or are close to being there. I think the rest of it is learn to spend your money as well, which means enjoy the fruits of your labor. Too many times people save just for the sake of saving it, and I think the point of money is that money has only one objective in the end. It has to be spent. Your question is only whether you're going to spend it today or tomorrow. So build enough money so you can spend it tomorrow, but do spend it tomorrow. And I'll leave you guys with that positive message. But I think my thing about to everybody would be, if you divide your life into these three things, I think the financial part of it will be much more clearer.
Wonderful. It's really a positive message to leave. Who wouldn't want to watch all 4 Grand Slams? And I assume you mean the tennis one. I wouldn't mind watching the golf one also. But if you enjoyed listening to this episode, consider investing in Deepak's Capitalmind Momentum Small Case, a portfolio of up to 25 stocks selected based on sharp ratios and liquidity that you can track and invest in with your favorite brokerage account. Links in the episode description. Folks, that is a wrap on this episode of the Ideas Project. Hope you enjoyed this chat with Swarup Mohanty and Deepak Shenoy, and hope this helps you understand the savings market a little bit better and the kind of investment opportunities in the sector. If you like this episode, guys, please do consider subscribing to the podcast and leaving us a review on Apple Podcasts and Google Podcasts. This podcast is powered by Small Case. Big thank you to my guests, Deepak Shenoy and Swarup Mohanty. Guys, thank you so much for doing this episode.
Thanks, Anupam, and great to have met you, Swarup, as well.
No, my pleasure. I was just thinking of that and reflecting on that in the last 1 minute. It's fantastic, and I really enjoy so much learning from you, Deepak, and thank you so much for having me.
Thanks, folks. And we will come back with more insightful conversations to help you achieve a well-rounded investment portfolio. Until then, bye-bye. See you next week on a brand new episode of the Ideas Project.
Hello. It's been another great week on the IVM Podcast Network. On A Sip of Finance, Priyanka doles out tips on how to choose the right mutual funds. On The Wire Talks, Siddharth talks to Apar Gupta, Executive Director of Indian Freedom Foundation, on the need for a law to protect personal data. On Ikaduka Economy, Abhinav talks to Vikram Limse, CEO of Helicon Consulting. The duo discusses the impact of economic recession on our lives. On Think Fast, Varun and Suchita give their take on TikTok venturing into music and what that means for its counterparts. And on A Niche Thing, Anish talks to the founders of Plant People, Komal Garg and Angus Bhalla, on how to select the right indoor plants. Once again, would like to remind you all about our merch. There's some amazing stuff out there. Please go to our website, ivmpodcast.com, click on the shop tab, and do check out what's available there. I'm sure you'll find something you like. Do follow us on social media. We're IVM Podcast on Twitter, Facebook, Instagram, and LinkedIn. And also, I'd like to remind you all to please tell a friend about this show if you're enjoying it. It will give you somebody to talk to the show about. Yeah, it really does help us too, so that too. Also, please rate us on any of the platforms you're listening to us on, and you can check us out on YouTube. We have a page on our website which basically lists all our YouTube channels. Please go check that out. And finally, we would like to thank our sponsors this week, Boat Lifestyle, Small Case, and Intel vPro. Thank you so much for making this possible.
Don't you think that if everyone around you is getting smart, you better be smarter? Hey there, I'm the traveling professor Siddharth Deshmukh, and I'm back with season 2 of my podcast to make you smarter. Smarter with Sid. What's this season's focus about? Well, it's about 10-minute nuggets that will make you stand out at work. It's time to go from smart to smarter. Tune in every Tuesday and Thursday and become smarter with Sid.